In this week's video, we'll review the latest charts that tell us the remainder of 2021 could be a whipsaw-filled and wild ride for investors. We'll be building on the concepts from recent videos, and we will be moving very rapidly. We'll start with recently flashed signals. As a breadth indicator, we've covered charts like this numerous times in the past. This tracks S&P 500 stocks greater than their 200-day exponential moving average. The reason for showing it gave us a reference point this week. It hit a new high for the rally off of the March 2020 low with a reading of 93%. We have data going back to 1999, and we're looking at all of it. Given this indicator has only been this oversold 3 times since 2000, 2002, 2009, and 2020, and given there's only 3 times where we move from the bottom blue line to the upper green line, we have something that just happened this week that once again ties 2021 to 2010 right inside this box and 2003. We hit the upper green line on March 23rd. And we know this is relevant because all of it speaks to human behavior. These rare thrusts after the low tell us a lot about future economic and market expectations. You can pause your video player here. Mr. Livermore's quote reminds us why all of this is so important. Since something that just happened on March 23rd right here is similar to this point right here where my cursor is in 2010 and this point in 2003, it might be helpful to know how the stock market performed walking forward. Upper right-hand corner of your screen shows subsequent S&P 500 performance after the date of the signal, looking out 1 to 4 years. As you can see, very favorable, especially from a longer-term perspective. In both historical cases, the market rallied further before hitting an intermediate-term peak. In one case, it rallied 4.35%. The other case, roughly 6%. For an average gain of 5.2%. From this point here, we hit the Nordique phase. If we go over here, these numbers represent the drop from this point up here at the intermediate term peak. 8.16% and 15.99%. The average was 12.08. How about the maximum one-year drawdown from the date of the signal, which is similar to March 23rd of 2021. The top and bottom lines show you the maximum one-year drawdown for the 2 cases in the study. This is the average of the 2. It aligns with a lot of the data that we've covered in recent weeks and months. We should keep in mind, in the 2 cases, we went higher and then we went lower. Look how many days from the date of the signal the low was hit. And hypothetically, from the date of the signal, one of the cases would take us back to 37.50 sometime in the next 12 months, and the other case down to 34.82. Again, this is the average of the 2. That would be 36.15. And remember, in both of the historical cases, we went higher first. So if we do the calculations from the date of the signal in 2021, that would hypothetically imply that the market could hit an intermediate term peak based on this data set at 40.80, 41.13, or 41.45. That's both cases, and then the average of the 2. In terms of calendar days, in the historical cases, hypothetically, that would land the peak somewhere between May 6th and June 30th of 2021. Notice the word hypothetical appears on this page twice. Can't emphasize enough, all of this is based on one data set, but if you watch these videos on a weekly basis, it basically aligns with everything that we've been seeing maybe over the past 60 to 90 days. Thus, if we're in a Nordique phase hypothetically where we rise an additional 5% from current levels and then fall somewhere in the neighborhood of 12%, it might be logical to try to assess the probabilities of how close we might be hypothetically to that intermediate term peak. We did work with 60 different data sets this week. We can't cover it all in this video. We'll show a handful of the data sets to give you a gist of the findings. These tweets provide a little bit more information about the work that we completed this week. You can pause your video player. Once again, we're looking at a breadth indicator, S&P 500 stocks greater than their 200-day exponential moving average. We're going over basic concepts here. This is an oscillator for the most part. It oscillates between 0% and 100%. Price is not an oscillator, so it gives us a different perspective on the psychology of market participants. And like price, we can have support and resistance and breakouts, support and resistance and breakdowns. If you look at the present day, this is dated March 25th, earlier this week. Notice, this is a little bit of a change in behavior. This could be the Coke machine starting to rock. This is a low, a lower low, and a lower low. This is a low, and this is a lower low, and this is a lower high. This is a breakdown here, right at the area where really bad things happened. You can see we're in somewhat of a box now. And as we mentioned, support and resistance, that type of concept applies to these data sets. And notice, when the indicator gets up high, when it gets up high, and when it gets up high, as it is today, in recent years, it has not been unusual for it to correct in a rapid manner. These are basically shorter-term bearish thrusts here. Notice we get the thrust here. Notice what the S&P does. S&P down here, S&P down here. So ultimately, in the present day, we're trying to understand if, when, and how this might break down as it did here, here, and here. Dating all the way back to April of last year, we've been tying the present day, the low here in 2020, to calendar year 2009 and calendar year 2002, 2003. And since this is an oscillator, it was oscillating between 0% and 100% in 2003 and 2009. These blue and orange lines show you the levels of support that were broken in the 2003 case and the 2009 case, just as the Nordique phase started. So you can see you break some form of support here, price falls. Break support, price falls. Have not really broken this support yet. And remember, the present day case has been tracking fairly well with the 2009 case and the 2002-2003 case. And in those two similar cases, when these hypothetical support levels were broken, that's when bad things started to happen at a faster rate. And in one case, we had an 8.16% peak to trough drawdown, and in the other case, roughly a 16% drawdown. So you can think of these as somewhat probabilistic lines in the sand. The longer we stay above the blue lines here and the two orange lines, the better. The further we move in this direction from a probability perspective, the more concerned we should be about the market potentially going into that Nordique or give back phase. Nothing magical about any of this. All of it speaks to probabilities. Also noteworthy, see how far the indicator falls here, the COVID plunge? How far it falls here in 2018? In the 2003 and 2010 case, it wasn't that bad. This is where you found support. So in those historical cases, between this area here and this area here, on this indicator, that's where these big givebacks occurred. And we all know the CCM market model uses a weight of the evidence approach, so we did something similar with 60 different data sets. And the takeaway from this one is really not too bad right now. Not a serious breakdown, but we do have a little bit of a rocking back and forth on the Coke machine. This could be foreshadowing a move into this direction. The emphasis is on could. This indicator was tied to the S&P 500. This indicator is tied to the NASDAQ composite. NASDAQ stocks greater than their 50-day exponential moving average. Since the March low, subtly, for the most part, we've made a low, a higher low above this upward sloping trend line. Here's a little bit of a Coke machine rocking look that could be foreshadowing something going forward. And notice, we are in this area here where the probabilities are starting to decrease, but we haven't exceeded these lines yet. This is basically telling us the probabilities were more favorable up here, and in here they've been less favorable. If this chart rights itself, we'll take it day by day and see what happens. This is not overly alarming at this point. It's simply saying pay closer attention, and we may be getting closer, weeks or months away from a drawdown period. If you follow the markets, it's not shocking that the NYSE looks a lot better. This isn't really alarming here. We're above all of these thresholds from 2003 and 2009. The look of this chart says the odds are that the market's going to make an attempt to make a higher high, which it almost did on Friday. And this chart was dated March 25th, and that's still the same conclusion. Same thing here. NYSE stocks greater than their 200-day exponential moving average. This is still solidly within the band. You can see we haven't broken support here. Notice when we break out here, the stock market rises. Just the opposite could happen in the future. It's really not likely that this indicator stays up at this elevated level indefinitely. It's really just a question of time, a matter of when, not if, when it's going to drop back down a little bit. That's just the way it works. March 25th, NASDAQ greater than their 200-day exponential moving average. Same thing here. Doesn't look too bad yet. It's looking more vulnerable. See, this is a lower low here. This is a lower high. Out of the 60 data sets that we looked at, maybe somewhere in the neighborhood of 10 to 20% have a pay closer attention or this is getting concerning. And 80 to 90% of them really look fine and tell us it still may be a little bit premature to get too defensive. I can't emphasize enough, that statement can change very, very quickly in this type of environment. So really the point of all this is the present day charts are still in alignment with these two historical cases. It's probably fair to say the Nordique phase is still the base case, and we're still on track for the possibility of the market rising 5% higher, give or take a few percentage points, and then having a fairly significant give back somewhere down the road. This is calendar days here. And then having the secular trend resume and having good things happen for a long period of time. If you're a client, based on the work that we did this week, very, very comfortable with our allocation as it stands today based on the facts that we have in front of us today. Let's see what we can learn from asset class behavior. Moving quickly here, the rate of change of the equal weight S&P 500 ETF relative to long-term treasuries TLT tells us a lot about what's going on in the minds of investors. A huge move like this in the ratio, last time it happened, March 8th, 2010. This is what happened walking forward from March 8th, 2010. And this is relevant again, something that just happened this month ties the present day to March of 2010. In that case, the market rallied an additional 6.92%, hypothetically taking us in the present day to 42.50, and then it had that 16% drawdown, hypothetically taking us to 35.70 if we followed the historical path. We know with 100% certainty we will not follow any historical path in an identical manner. It's possible it could be similar because human psychology is similar. So if we add in this maximum hypothetical 1-year drawdown, this is where it would show up on a present day chart hypothetically, and if we put the hypothetical target, it would be 42.49, and in terms of the number of calendar days, it would hypothetically occur in 2021 on May 2nd, simply giving us some levels to manage against. The S&P 500's rally off of the March 23rd low is the biggest rally in stocks since 1936. What happened in 1936 after the day that was similar to March 23rd, 2021? Somewhat of a Nordique thing. We gained, gave it all back, went up 4.3%, then dropped like a stone, 13% roughly, and from this low, rallied 38%. In this case, hypothetically, your upside target would be 40.78 on the S&P 500. Your downside target, hypothetically, would be 35.58. and from that low all the way to 49.09, with the emphasis on hypothetical. If we add that maximum 1-year drawdown to the same chart, here it is, 35.58, and the upside target 40.78 in the short term, that hypothetically would occur on May 8th if we followed a similar path. Thus, recent signals tell us it's within the realm of possibility that the S&P 500 could have an intermediate term peak somewhere between 40.78 and 42.49, and hypothetically it could occur somewhere in the May 2nd to June 30th window based on these data sets. But this is similar to studies that we've completed in the rearview mirror. If anything, some of these drawdowns are a little larger. We all know we do not trade historical studies. We trade the charts in front of us. Triple Qs versus VTV. This change here that started at this high in early September, if you look at our allocations to tech and growth relative to other positions, are we allocated properly? Were we allocated properly here? Yes. Are we allocated properly here? Yes. Do we like this chart in its present form? We do not. It has work to do. But just as we did from this point to this point, we'll take it day by day and continually ask, are we properly allocated based on the facts in front of us? We have no bias as to which way this chart's going to go. You can pause your video player. We have a lot of cross currents going on in asset class behavior. If you're a relatively new client, this makes for a harder entry point. So just be aware, it's possible we could be making some moves and reversing those moves relatively quickly. The goal is to get the allocation right on a longer term basis. That's standard operating procedure for clients that come in after a big rally. This is gold versus bonds. You can make an argument this is somewhat of an inflation expectation type chart. Here's the COVID plunge in the ratio. This is what fear looks like in the rearview mirror. The present day looks a lot better. Notice this look here, somewhat of a breakout and a turn up. Is it possible? It's similar to this point here? Sure, it's possible. This may happen, but we really don't have any evidence of that yet. This is about 3 p.m. Eastern Time on Friday, March 26th. JNK-IEF making a new high. This is the highest point that it had been since the March 23rd low. Is JNK-IEF a perfect way to look at the credit markets? No, it's not. It's a proxy for the credit markets. We use this ratio in these videos because it's an excellent visual. It's very, very difficult to make an argument that the message from JNK-IEF has been any different from the message on this chart here. Even if we zoom in here, this is still in a downtrend. There's no higher high on this chart. Yes, you can say that this trend is starting to somewhat flatten out, and it's possible it could turn up, but you know what? It's also possible that it's going sideways and it's going to fall again. It's also possible it's going sideways and it's going to fall again. The point is, credit spreads in the present day don't look anything like this move here in Q1 of 2020. Like everything else, that's subject to change, but that's the data and the chart that we have in front of us today. Similar situation here. This is what it looks like here in Q1 of 2020. When stocks are tanking, this is the present day. Not a lot of fear on this chart yet. Before we go to the summary slide, there is one bullet point that's very, very important. Right down here. It's very, very dangerous to get stuck on any story in the markets. What do we mean by that? If we feel like we know what's going to happen, we're in a Nordique phase. We're going to go higher, then we're going to give it all back, and then we're going to go higher. That's getting stuck on one story. That is the complete opposite of maximum flexibility. As Q1 of 2020 illustrated very clearly, in the financial markets, anything can happen at any time. And if you get stuck on a story that's either bullish or bearish or sideways, and some other scenario plays out, especially if it plays out quickly, it's going to be very, very difficult to manage risk properly. That's why we're constantly covering these topics. None of this is a forecast about anything. It's helping us assess the probability of good things happening relative to the probability of bad things happening based on the data that we have in front of us. It gives us something to manage against. The base case is in play as long as the charts in front of us align with the base case. Trading historical studies is getting stuck on a story. We trade the chart in front of us. That enables us to react if anything happens at any time. If the data that we see in the coming weeks and months aligns with the base case, we'll learn something. If the data that we see in the next few weeks and months contradicts all of this, we'll learn something as well. But we'll only learn something if we review that data with an open mind. If you're relatively new to the markets, this bullet point, speaking from experience here, is very, very important. And you can combat it by waking up every day with an open mind. Basically saying, I have no idea what's going to happen today, but I'm confident that I can deal with it. Thus, we're always open to all outcomes on all time frames. And if we're willing to listen to the market and to head into next week and every week with that flexible, unbiased, and open mind, we shouldn't drift too far from the proper allocation. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.